Welcome everybody. This is the Thursday evening Viper trading webinar. If you are here to learn about trading the Viper systems using the Viper tools in the futures markets, you're absolutely in the right place. Tonight's topic is, drumroll please, knowing when to stop trading. Now, we have a lot of new folks in here tonight, so I'll tell you what we're going to do. We're going to expand that topic to include instrument selection, trade entries, and some other goodies that I think are important. But before we get into that, we have to knock out our standard disclaimer, so let's take care of that. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of a loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everyone in here does know that you do trade at your own sole discretion. If you are just coming in, you've not missed anything. We're just getting started. So without further ado, let's get over to some charts. Switching to screen one. Now, what I'm going to do, here's how I want to kick. Here is YM starting at midnight last night. So I'm here in California. This is all Pacific time right here. And when you look at this chart, is there a trend on YM? Yes or no? And if there is a trend, what is it? Just looking at the chart from here to over here. Is there a trend? Yes or no? And if there is a trend, what is it? Most of you know, of course, trends are either up, down, up or down, because sideways by definition is not a trend, right? When you're range bound, that is by definition not a trend. So if you say, yes, Charles, there is a trend there, then it's either going to be up or down. Yeah, of course there's a trend. It's up. How do we know that? Well, you're getting a series. There's a lot of breadcrumbs that we look at when we're looking at a chart. And some of them are visual and some of them are more intuitive. So for instance, here you can see that we come out of this sort of stripe background effect here. And then last night, overnight in the Asian session, our background turns green. The bar color is predominantly blue. The mid-band and all the other bands are stair-stepping upward. And you're getting what's called a series of higher lows and higher highs. So by definition, in this case, this is an uptrend. Now that we all are on the same page, what types of trades do you take in an uptrend? You got long or short. So you type in an L or an S. It takes you 2 seconds. Type in an L or an S. Are you getting long or short in an uptrend? It's a simple question. Long. Long only. Let's put that in here. We'll write it down. It reinforces the thinking when you write things down. So it goes without saying that we all acknowledge the fact that when we're in an uptrend equals long trades only. Now, there are a few exceptions to that around, news events and crude oil inventory and market opens where it's flipping around, all manner of things like that. I don't want to confuse any of that right now. I just want it to be really simple and straightforward. If you are in an uptrend, you are getting long only. No shorts. Okay? Now, we have a number of different ways in which we get long in a market. And let me explain what those are. When you're in a trending market, and in this case it's up, you have two types of price action that occur in the markets. You have what are called the push in the trend direction, and the push in the trend direction is called the thrust. Okay? So in this case, the thrust is what? The thrust is up, right? And then, in order to get higher highs and higher lows, you have what is called a retracement. This is called, let me blow it up a little bit so we'll all get on the same page. And before we start looking at more, we're going to look at trades in a second here, but you got to get a good foundation before you can put your house up, right? You can't build a house without a good foundation. So you have retracements that come after the thrust, and the retracements are in the case of uptrend, in the opposite direction. So a retracement is a downward move in an uptrend. Now, when you look to get long, and everybody in here said the trend was up and we're buying to get long, do you get long on the thrust part of the move? If that's true, type in a T. Or do you get long on the retracement part of the move, where you would type in an R? Do you get long on the thrust? You would type in a T. Or do you get long on retracements, where you would type in an R? Yeah, retracement is also called a pullback, Dennis. That's correct. There's lots of different names for it: retracements, pullbacks, etc. The principle is the same. Good. Everybody typed in R. This is another important thing other than what instrument to trade that you want to take away from tonight and just carve it right into your little trading memory there. We are retracement traders. The thrust is the move where, in this case, buyers and buy programs, algos that are running in the market from various market participants, are pushing the market higher. Now, in an uptrend, what causes a retracement? Why is it doing this? What are the forces that are causing it? In other words, why doesn't a market just go straight up? You start here, big boys turn on the buy scripts, the algos start pumping away, they're buying, and then you go from here straight up to here, straight to here. Why do markets pull back? What's going on? Why don't they just go straight up? What's the dealio? Profit taking. Profit taking. That is exactly what is going on. All of the market participants who are long from lower levels, wherever they got in, eventually when the market proceeds to a certain level, in this case it was right here, there begins to be profit taking. Now, to be clear, the difference between this and selling, and we're going to look at selling in a minute because that's the opposite direction, which is down, right? Is this is profit taking, and that's what causes the retracement. All the market participants from down here are taking profits, and so naturally the market is going to pull back. Now, one of our favorite trades that you should look to master, and if you're beginning and you're starting out and you're brand new with us and all that sort of stuff, it's called the mid-band trade. And you hear it in the room all the time. What is a mid-band trade? Okay, everybody sees this is midnight, right? So I'm going to get this line out of the way so we're not confused. Now, this is midnight last night. If you trade the European session and the tail end of the Asian session, you might, or you're a night owl and you're up, you might have been watching the markets here, but probably you might have been asleep. This would have been 3 o'clock Eastern time, right? 3 in the morning. But notwithstanding what time it is, the principle is the same. It comes down to this. And I'm going to start off as simple as I can, and we're going to expand on the basic idea. The idea is that the retracement comes right to or close to the midband. If you're looking at this for the first time, the midband is this thick, chunky line right here. That's called the midband. And we like it when markets come back to it, particularly in an uptrend or a downtrend, because this is where we look to take trades, right in here. This is our sweet spot. Okay? This, as you're learning how to trade futures markets, this would be the absolute first thing to try to master. This trade right here. The trade at the midband. We have a lot of traders that have been with us for a very long time, and some of them, this is all they trade is midband trades, and they make a very good living doing it. The key here is to find trade entries that you like, get very, very good at them, and then repeat. Okay? Now, that's not to say you shouldn't learn other trades. There's phantom trades. There's all manner of different trades. We teach, because we got traders all over the world trading different instruments and all sorts of stuff. And so we have to have different trade types. We just can't limit ourselves. We can't just put this hammer in our toolbox and try to go build a 20-story building. Okay, we have to have other tools. But what I'm trying to say here is that if you're going to start with something to master, this would be it right here. Here's another one right here. Right here. So when we say in the live room for any instrument, it doesn't matter what it is, I am looking to get long on a pullback around the mid-band on YM somewhere around 925. So if you hear those words and you're trading YM and the market is actually sitting up here, the comment, the market is here. The comment might come in when the market is actually here. If the market pulls back anywhere around the mid-band at 925, I am looking to buy a bounce to get long. So why are we talking about here when the market is here? Why are we doing that? What does this 925 have to do with the fact that the market's actually sitting at 949? What are you talking about, Charles? I don't care about that. I'm going to trade from down here. I want to take some profits. Thrust retrace, that's right. We're looking ahead for retracement at the mid-band to take a trade. That's right. Good. So here's the thing, and this is a difficult transition for many traders. We have to take into account multiple conditions when we are looking for trade entries. And here's how we do it. It's really simple. We take this demarcation point, wherever you're looking at, whether the market is up, down, or wherever it is, and we look back like this. And we look for support and resistance areas, and we can put lines there like this. We can put a line here. And we even could put a line up here, we could put a box up here, or we focus on the fact that the mid-band is here. And you might do some fib calculations. What you're trying to do is also think forward beyond the right-hand side of the chart. So we're not just staring at a price that's up here and saying, doop-a-doop-a-doo, man, I wonder what this thing's going to do. I hope it keeps going. But you know what? Maybe it's going to pull back. I'll just react to whatever happens. I think the trend is up. I see the green background. Maybe I should buy, and I'll just have to see what happens. What I'm trying to tell you is that to be a successful long-term trader, you can't not adopt a lackadaisical approach. It's not healthy to go into a market and say, well, I'm gonna see what happens and I'll react to it. When I see it happening, I'll know what to do. I mean, is that a healthy approach? Of course it's not. So what we're doing here is we're looking forward. We are anticipating what might happen. In this case, a retrace back to or around the mid-band, in which case we are looking to buy long. This is the planning ahead part of the trade. It's critical to your success. Critical. Because if you're not looking forward and you're just waiting for pullbacks, it's going to be very difficult to make money in the long term. Okay, does everybody understand that? Now let's look at the dynamics of the trade entry. Here we're pulling back, here we're pulling back, here we're pulling back, and now let's get into the meat and potatoes of what we're talking about here. The market has come right back to where we wanted it to come, 925, and it hits it right on the button. Now you might say, well, look, Charles, why don't I just put a buy order right here? Huh? I'll just put a buy limit order, and when it touches it, I'll get filled and I'm long. Isn't that the best entry? Well, maybe, maybe not. What if you buy this bar here because it hit the mid-band and you had a buy order right there and you get filled long, and all of a sudden the market gives you a bar up like this and maybe one more up a little bit more, and then next thing you know, it tanks right in your face and comes all the way and takes your full stop out. So the workaround to that, and it is a later entry than buying the midband, and you certainly could buy the midband. If you're good at pegging support and resistance places, and you feel confident it's going to bounce right there, you absolutely could buy it. So that's not what I'm saying. What I'm saying, the other alternative is to wait until you have confirmation that this support has held and that the market then again is going to go higher, like that. So this is where now I'm going to discuss a couple of different entry types. And this is going to expand your repertoire beyond using object trader boxes. When we say put a box there at the midband, I'm getting long only. What those words actually mean is you would have the object trader panel open here, turned on, connected to your sim account or whatever you're trading, your live account. You would get the region box and you would draw it here thusly. You would enable it. You'd have your targets, your stops, and all manner of things enabled. And then when a bar closed up, like that bar right there, what physically happens in the market is as follows. If you had close outside the region box enabled to get long, Object Trader will fire a market buy order to be filled on the close of this bar, and it will also put in whatever targets you have. Say you had 2 lot on here, you had a target here, and I don't know, 20 tick target up here somewhere. Okay. And it will put in your initial stops. Say you had a 12 or 15 tick initial stop, and it'll put that, if you had 2, it would put 2 down here. It would put your targets and stops in, and if you had trail enabled, it would manage the trail stop accordingly. In this case, of course, we see it dawdled around here a little bit, kind of dinked around, and then it started to take off. Now, you might say, Charles, look, I'm still learning this whole object trader thing. It's confusing to me. It's going to take me a little time, but I still want to trade. How would I do it? I would say this. Excuse me. Hold on a second. You would identify the same area that you have right here. You could draw a box. You don't have to draw a box. The box helps you see the top and bottom of it. And you would simply put a buy order in here, like that. Now, when this bar closed out, it would do exactly the same thing as Object Trader. It would get long on wherever you put this buy. 34 here would be long, just like OT, except it wouldn't do it at the close of the bar. It would do it wherever you had the order. It would fill long. Now, here's the thing. You're going to have to manually manage this trade now, because OT is putting in the targets and the stops, right? When you put a limit order in yourself, you have to manually manage it. So in other words, you would have to come and put your target in here, wherever you want to get out. Put your stops in here. You'd have to manually manage that. The trail stop would not be automated. You have to trail it up yourself, like that. So that is another option for your entry. As you're learning how, by the way, I'm not telling you to put limit orders everywhere and forget about Object Trader. That's not what I'm saying. I'm saying that Object Trader is a very important tool to your success, and it's really important you learn how to use it. Region boxes and all the functionality in there, it's really, really good, and it can make you very good money. What I am saying is this, is as you're learning how to use that tool, there's other ways to get in. And limit order is the simplest one, especially when you see consolidation around the midband like that. The obvious difference is you have to manually put in your targets and your stops and manage your trail, yourself. OT is not engaged. It's not going to do that for you, right? We're doing more of that, Brian. Brian having comment on the boxes themselves. If you notice, Gary's doing a lot more about that. Yeah. Now let me explain one other thing here on this box, and I want everybody to really focus in. I'm going to do several of these, so that tomorrow morning, when you're looking at your charts, it's very clear to you what we're doing. This is going to be critical to you making money. Now, let's look at the anatomy inside this box. What's going on here? You have a bar closed down, bar closed down, bar closed down. doji candle, bar close up, bar close up. Now, most times, not every time, but most time, a high percentage of times, let me just leave it at that. I don't have an exact percentage, but a high percentage of times, you're going to have at least 3 bars in here. 1, and I'm saying inside of this box in the retracement, 2, 3, 4, 5, and then it closes out. Sometimes it'll be 2. Many times it will be at least 3 or more. And so you want to see, I'm going to draw a retracement line here so it's really clear. If you drew a retracement line over the tops of the candles as this market was pulling back, where did the retracement go from pulling back down to resuming the up movement? Right here on this bar, right? That's why, in my opinion, it is far better to put the limit order buy or the OT box or however you're getting in here. There's trend lines, rays you can put in here. Wait until you have confirmation that the uptrend has resumed on this bar right here. Does everybody understand why that is and why we're doing that, right? We'll look at cases here where you'll have bars that'll chop around here around the midband, and then all of a sudden, next thing you know, and I'll show you cases of this, right? If you bought the limit order right at the midband, bam, the thing takes it out and then right down in your face. NASDAQ is notorious for that. By the way, that's one of the other reasons that we are suggesting that you focus on YM and the Russell in your early stages is they tend to they move a little slower, okay? So you have more time to think about what you're doing. They tend to respect the swing levels a little better. If you look at the NASI chart, it's all over the place like a spazzy thing, right? So there's reasons why, aside from the fact that it has good volatility, $5 tick, you can eventually leverage up to 2 or 3 contracts and start making very good money. You're not going to be stuck at one contract forever, but you have to learn these entries first. Okay, you got to learn these entries first. That's the key. Now let's see how much money this trade made. Let's just do one. Let's say you got one contract. And, you know, maybe you had a big target way out here somewhere and you trailed to stop. So you trailed to stop, you're sort of following it up, you're listening in the room, and maybe you get taken out, you know, somewhere around here. So you got in at 34 and you got out at 55 on one lot. How much money did you make? You got long at 934 and your trail stop was taken out at 955. How much money did you make on this long trade? Well, let's do some quick math. 955 minus 934 equals 20, what is that, 21 ticks, right? 21 ticks. Times 5, YM is $5 per tick, right? Equals $105. You know, less commission. I'm just using this as an example. You know, where you actually got filled, there might be some slippage. You know, maybe your stop was tighter, maybe it was looser. I'm just using this as just an example to show that, to illustrate this trade. Now, a couple of things to note. You almost didn't feel really any heat. Now, when we say feeling heat, what does feeling heat mean on a trade? You might hear that in the room or other traders talking about, man, I felt some heat on that trade. Gee, before that thing took off, I felt some serious heat. What does that mean? Feeling heat. What does that mean? You got like a Bunsen burner under your bottom? You're getting cooked? The fire's too hot in your house? What does feeling heat mean? Why does anybody even say that? The term makes no sense. Feeling heat. Feeling heat is when a market pulls against your entry and you're upside down and it has not hit your stop. So here's your initial stop down here. Let's use an example. 15 ticks below, so that might be, you know, down in here somewhere. Here's your stop, your initial stop. You should always put that in, by the way. OT or not, you got to get that in, okay? In case some crazy thing happens in the market. Now, if you get filled here at 34 long on the limit order, you can see here it went up and tried to get to 40 and then started pulling back against you. So, it might be up $5, down $5, up $10, $20, down $5. So when the market starts pulling against your entry, that's called feeling heat. But it has not hit your stop. In other words, you're upside down in the trade and you feel the negative pressure on you. It's pulling against you, right? You need to learn how to deal with that because that's going to happen. That's one of the realities of trading, feeling heat. Market, this is a rare case where it took off, you get a couple of ticks of heat and then bam, the thing took off. Now, some of you might be saying, Charles, that looks really good. I see how to do that. That's cool. But look, I only made $105. I can't live on that. Well, let's do some more math. What if you got so proficient at this type of trade that you felt comfortable on the next one, or maybe a week or two, somewhere down the road, you would put 2 contracts on. Now how much did you make? 2 lot would be how much? $210. You can do the math, right? 3 lot, right? How much is that? $315, right? I mean, you see where I'm going with this, right? So it's not, and this is where I find so many traders, and it's just so unbelievable over the years I see this, is that they get caught up too much in, I only made $100 on that trade. Well, did you execute it correctly? Did you see the proper entries? Did you buy and get long? Did you manage your trail appropriately? Did you learn the mechanics of the trade and execute it efficiently? Yes. Can you do it again? Yes. Well, once you get really good at it and your success rate's really high, go to 2 lot. Now, if you made, let's say that you have the experience to trade 3 lot and you made $300 on this trade. How many of you would keep trading? How many of you would stop? If you made $300. Show of hands. Let's say it was $315 less commission. So it's roughly, netting somewhere around $300. How many of you would stop trading? How many would you keep going? And how would you know? How would you know to stop? Is it just a feeling thing? Well, I like 300. I feel good about that. I guess I'm going to stop. Or is there some other reason why you might do it? Hey, look, Charles, I'm just happy I made some money. I'm like, I'm just going to bank the 300. You have to have a goal. That's right. Who said that? Some people would keep trading, and then some would stop. I see Rob would stop. Rick would keep going. Brian, your scalper, let it all run. Set some rules. Mario says I'd be close to my goal. I'd go ahead and stop. All right. So this is another rule that's extremely important, and there aren't many of them, but it's important that you remember them. You want to stop trading when you are at or close to your goal. You need, every single person in here tonight and listening on this recording needs to have a trading goal. What did you hear Gary and me say all the time in the live room? What did I say today about 7:20? I don't know, maybe it's closer to 7:30. Didn't I say I'm close to my goal? I'm done? Well, how would I know that? Well, because I know what my goal is, and I know where my P&L is at all times. And I know for a fact that if I get, this attitude of I'm trading with house money and I'm on a win streak, I'm just going to push the limit, I'm going to keep it going. How many of you done that? And then, what happens is not only do you give back the money you made, you go home a loser and you lost it all and gave it back to the market. Anybody done that? I know I have. I used to do it all the time. Yeah. Yeah, my wife thought I was insane. A lot of people thought I was insane. Maybe I was somewhat insane. Sure. I'd get up early in the morning, get a little bit, big-chested about it. Man, I'm knocking out of the park today. I'm just going to keep, I'm on a roll. Bam, you take a hit. Bam, you take another hit. Oh, then you get into revenge trading. Oh, man, you know what? I got to get back to where I was. This is ridiculous. Bam, bam, another hit. Now you're upside down. So you didn't go home with 850 bucks that you were up in the first, half an hour. Now you're upside down 250. I know that's happened to a lot of you. I know it has. You just admit it. Whether in sim or real money, it happens. Yeah, and a lot of people used to do that. Okay, here's how you avoid it. You set realistic goals. You set your max stop outs for the day, and then you respect them. And if you get anywhere near what your goal is, you stop and you go into sim. You've got to stop. This is going to keep you alive for years to come. If you ignore what I'm saying, you're going to unfortunately fall into that group that does the repetition of what I just described. Up, 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 doing good for the day, risk, 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 lose money, go home with losses. Let's look at another trade. Okay, I want to look at a couple more trades here. I don't want to spend all day on this. And then I want to switch over to RTY. Is everybody clear what we're doing here? I tried to be as clear as I could. I'm not mincing words here. I'm just saying, I'm just laying it out the way it is. Okay? All right, good. I don't see any questions. Now, what I'm going to do is this. In this next exercise, I'm going to take this chart and I'm going to advance it bar by bar. And when you think you see a trade that you would take, excuse me, hold on. Based on everything we discussed here tonight, you type in the letter T. Okay? So don't worry about any of this stuff over here for now. Okay, this is our goal. This is the thrust. We all know how this all works, right? We're going to focus our eyes right over here to the right. I'm going to advance the chart bar by bar, and then when you think you see the trade entry, you type in the letter T. Okay? All right. Stand by. Here we go. Oops. Hold on. I got a little sideways there. Oh, there we go. Okay, good. All right. Okay. Bar by bar. Now remember what we talked about. You don't have to call out what type of trade it is because we know you're going to get along, right? So here we go. Okay, now you're at 2:28 in the morning. Some of you might be up, you early birds. 2:44 in the morning. 3:01 in the morning. 3:02 in the morning. 3:14 in the morning. All right, I'm going to stop it right there. Now, okay, that was good. Okay, I'm gonna say this as nice as I can. Okay, and I think it needs to be said this way so that we all, don't have any confusion about what we're doing here. Some of you typed in a T when the bars were here. And, in some cases that might be if you have a very powerful uptrend and you're only getting shallow retracements, that might be acceptable. But in this case, we're looking for it to go deeper because we want the risk return to be better. You can see that if you get filled long on the top of this bar, it doesn't have much to go till it hits resistance. And so there's not a, and you got to put a stop way down here. So the risk return is not very good on that entry, right? Now, many of you typed in a T when these bars started forming right here. And that was correct. That was right. Remember, at this stage of your development, we are looking for entries at or around the midband only. So you have to be patient and wait for it to get there and then take action, just like you did over here, yes? This was the entry here. 1, 2, 3, up. Those of you who put boxes, you would put the box around here using your region box tool. Those of you who use limit orders would put your buy order right above here. Everybody see that? Just like that. Now, some of you typed in a T when the bars were up here. Now that is incorrect. Now here's why. And don't get me wrong. Look, I'm not trying to chastise everybody here. Look, some of you are just looking at this for the first time, so I totally understand that you're learning it. But here's the thing. You can see by the time that this market got back up to here, from here, that you were already in another thrust part of the move, yes? The market was thrusting again. We have to buy it when it comes down in the retracement and check support in an uptrend. You're getting in down here. Now I know why some of you typed that in, because I used to do the same thing too. You want to be convinced that the market's going up again, right? And it takes these bars to get up here for you to be convinced. Not they're up here, you're like, hey man, this thing's taking off. I got to get in here now. Well, no, you don't want to do that. It pulls right back in your face. If you got filled long on this bar, it might actually stopped you out before the silly market took off and had a nice run. Markets have to check support. In an uptrend, they have to bounce. You have to get the proper entry. When a market's up here, this is an important cautionary tale. If you look at a market and for some reason, whatever reason, you didn't get in down here and you're looking at it here like, I better jump on it right now or I'm going to miss the next big move, there's a strong possibility of a chance it's going to pull back in your face and stop you out, because the smart money was getting in right here. Oh, wait a minute. Hold on. Everybody see this? Let me go here. Let me go through that again. This is where some people typed in a T. And what I was trying to explain is that this is already in the thrust. In fact, some traders are already taking some profit here. Everybody see that? Now, you could make the case, well, Charles, look, it pulled back and it held just above the box. Could I have gotten in here if I missed it? Yeah, absolutely. Sure. That's another chance to get in right here. That's another retracement. It's checking support, a higher level of support. Absolutely. That's a secondary entry right there. No question about it. What I was also trying to show is that you don't want to get in when the market's way up here. We see that it's just a total no-no for us to buy thrusts. We're not buying and selling thrusts. We have to get into retracements to support resistance. Yeah, Lee, I showed that earlier. In this example over here, I actually put a buy limit in, or let's go back. You might have missed that. Yeah, I said it's acceptable to put a buy order. If you think it's going to bounce to mid-band, you have clear evidence that you want to get in right there. Absolutely, put the buy order right there. Now, the advantage of this too, if you do take the aggressive entry, is that you can have a very tight stop. So let's put a sell order in here and pretend it's our stop. Okay, you don't have to put that thing way down here, 15 ticks down, and say, oh well, I hope it takes off and then it flips in your face and bam, you get nailed. No, put that puppy right under here. I mean, in this case, you're risking like what, 3 ticks? Yeah, so you can take an aggressive entry. Absolutely. I wasn't poo-pooing that. What I was trying to say was it is more conservative to get in when it breaks up like that. No question about it. But, you're getting in arguably 6-8 ticks after the bounce occurred. It's something on the instruments that you trade that you're going to have to personally experiment with. That's the critical thing. Try the different entry types, see what works best for you, and then continue that approach. All right, so here we had some trades. I'm almost running out of time here. I only got a few minutes left, but I want to talk about a couple of things here. Here was our secondary entry. This was a beautiful trade. This thing took off and made, I don't know, just look at some numbers here. Let's take this off real quick so we can get this, try to squeak in Russell before we run out of time here. I don't know, you got filled, let's use around number 50-ish, and you trailed it up and you got out at 82-ish. 50 to 82, 33 ticks, 32 ticks, times 5 is what, 160 bucks. 2 lot would be 320. Yeah, so this is the kind of trade you're looking for. This is the kind of trade you're looking for. You got to cut your teeth on these, okay? You got to cut your teeth on these. Now, I want to show you this something else, and then we get off of the Weimer. If you had put a buy order in at the this is an example where this trade didn't work out. A buy order at or a tick above the mid band, you would have been filled conceivably here at 68 long, right? This is a case where if you had drawn a box around the candles, you never got long yet. Now look what happens. Look where the market goes. This is what I was trying to tell you. This is where you're feeling a lot of heat. And those of you that buy here at the mid-band, assuming it's going to go back up, that's where you can get popped. So it's a risk return thing. If you think it's going to buy, you get in. In this case here, if you're not going to want the 15 tick stop, you get filled, maybe get filled on one of these bars here. You can see it's not getting out. There's a number of things you can do, right? Go in here and close the trade. Put your tight sell stop right here. Only take a lick of 3 ticks. Don't put your stop all the way down here if you're going to get in on that aggressive entry, because it'll come and pop you, and then watch what it does. Comes up, boom, and takes off again. Lee, you can put fibs on here. I usually like to see at least 2 or 3 candles form and to be able to draw a box, Rick. So in this case here, let me take these order offs. Everybody sees the issue on the tight stop on the aggressive mid-band entry, right? Everybody sees that? Okay. How this deeper retracement, you wouldn't just let it. Don't ever get into a hope trade, please, okay? You know what a hope trade is, right? You get long right here. Maybe initially you had a stop that was here. It starts pulling against you. You drag it out of the way. You drag it out of the way. You drag it out of the way. You're in a hope trade. You're hoping it's going to bounce. Sure enough, it comes all the way down here. You take a, 15 tick hit on 1 or 2 lot here. And then bam, the thing takes off and you're so spooked you don't get back in and you took a pop. If you decide that you're going to have an aggressive tight stop and aggressive entry, you got to respect your tight stops and just leave them there. Take the 3 tick hit. Okay? And move on. Now, in terms of interpretation of how a box is forming, you need to have at least 2 or 3 candles or more. In this case, you can see we have 1 candle, 2 candle, 3, 4. The box could have actually been starting to be drawn as early as here. Everybody see that? If you're looking at consolidation at the midband, here's what I'm saying. You've got to have at least 2 or 3 bars or more. 1 in the box, 1 at the midband, 1 here. And can you see the tops of these bars, and can you see these lines forming? Now, I'm not so concerned about putting the bottom of the box at the bottom of here, because I don't really care. Why don't I care about where the bottom of the box is? That's a question. Make sure everybody's still awake here. I mean, the bottom of the box could be here at the midband. It could be here. It doesn't matter. Why don't I care? Why does not matter? Why does the bottom of this box not matter? The location of it. It's a really simple question, a real question. Right, we're not getting short. We're getting long only. We only care about closes up. Thing could go down to down to the moon. We don't care. It doesn't matter. We're not taking shorts here, right? So in that respect, I mean, it's good to draw a good solid box, mainly because of the practice, and in some cases, if this was a condition where you were going to get short, yeah, you would put, technically speaking, the bottom of the box would be there, and then if you were taking shorts, it would close here, get short, close up here, you would get long. Yeah, that's if you're trading both sides. If you're long only, it doesn't really matter where the bottom is, because you're just looking for this. Right there, you're looking for that to get long, which in this case never happened. You extend the box out, keeps going, never closed up. And so it goes a little deeper. Now we call these phantom trades. Phantom trade is where we used to call them deep trades, deep bar probes, red bar probes. We had all manner of names for these trades. We have for a long time. Right now we call them a phantom because it comes out towards the outermost band. So in the case of an uptrend, you're going up, pulling back, up, pulling back. In this case, you get a deep bar probe where it comes down close to that outermost band. Trend is still up. Even though the background has changed, trend is still up. We are still buying. There were several spots to get long after the deep retrace. You had a chance to box it down here, and you had a secondary chance to box it right here. On here, you would have been, depending on how you drew the box, long with one of these 2 bars, And in the case of this box here, you would have been filled long on this bar, in this bar right here. All right, I think we're right at running out of time here. I did not get to RTY. My apologies. I got totally sucked into Weimer here. I promise you this. On Saturday morning at 9 a.m. Pacific, I'll have another webinar. I will get into all of the other instruments. I'll put Russell up. I'll take, I'll let the team call out what you want. I'll put 6E in the currencies, whatever you want to look at. I'll look at all of them. Okay, I'm going to turn the recorder off. Thank you for coming, everybody. Especially welcome to everybody.